Thank you for joining us today. We are going to talk in today's Connect conversation about uncertainty in the markets, which there is a lot of, and how that relates to your investment decisions as a plan sponsor. So my name is Matt Peterson, Executive Director of NAGDA. Joining me today for this very important and timely conversation is Josh Cohen. Josh is the Managing Director, Head of Client Solutions at PGIM, Prudential Investment Management. Welcome, Josh. Good to see you.
Thanks, Matt. Really appreciate you having me on this.
Yeah, absolutely. So let's take a minute to talk about the context of what's going on for this conversation. So the Trump administration has enacted several policies. A bunch has been going on in the first few months of the year. It's caused a lot of movement in the market. We've seen ups and downs kind of all over the place, most notably with on and off tariffs, but a few other things as well. Can you just give us a 2-minute, like a real quick, for anybody who hasn't been following the news? I'm guessing most people have, but just kind of a 2-minute update on how the markets have been reacting in the last few weeks.
Yeah, sure. Yeah, no doubt there's been heightened volatility since the beginning of the year, a lot of times related to the impending and now implemented or somewhat implemented tariff strategy. Certainly after the announcement on April 2nd of some very meaningful tariffs globally across just about every country, that's when we saw the big, particularly the stock market reaction. Over the next 2 days, the stock markets fell over 10 percentage points. Again, there's volatility up until then, but then we saw that big drop. And then, of course, there was some ups and down days after that. We also saw some volatility in other asset classes. Oil went pretty far down. Gold went down and now has actually come up a lot. Probably one of the biggest changes is interest rates. About a week or so after the announcement really came up. And I think that's maybe many feel is when Trump reversed the policy or put a pause on the tariffs once they saw the rise in interest rates. So obviously there's a big market rebound after that. Not as much on interest rates, but on the stock market there was some rebound. But it's been volatile depending on when this release. You know, we don't know what will happen. I would say the biggest thing that we've seen, maybe the most interesting indicator, there's something called the VIX, which is an indication of volatility. You use the word uncertainty, same idea. That continues to be elevated, which basically says the market really isn't sure what's going to happen. They expect a bumpy ride continuing, could be up, could be down, but they expect bumpiness.
Yeah, sometimes called the fear index, right? It's just kind of a nervousness, a little bit of a nervousness generally, right? So a great synopsis, and that gives us a good backdrop for what we're going to talk about today, because as you mentioned, it has affected, all the policies that have been implemented so far have affected not just stocks. Typically we think about the market, we just think about stocks. We look at the S&P, or we look at the broader indexes, but it really has been across the board: bond markets, fixed income, commodities. When we talk about, when you hear it in the popular press talked about, a lot of times it's the context of your DC plan or your 401k, but the perspective is always on the participant, right? Don't touch anything, don't look at your balance, take your time. But for plan sponsors, you might not have that luxury, right? You're talking to a group, you may have a quarterly meeting coming up, you may have your fiscal year coming up soon. So it's different conversations for plan sponsors in times of uncertainty. You all have done a lot of research focused on plan sponsors that I think is really interesting. Can you talk a little bit about what you've seen in some of your research when it comes to plan sponsors and market decisions, and what some of the principles are that you've pulled out? And then how does that relate to times like these, navigating through kind of more uncertain times?
Yeah, well, much like the guidance for that many give to participants, as well as the guidance to plan sponsors, is you never want to panic. You want to make sure you're still strategic, long-term perspective. But I've seen this before in the past. I think markets like this make folks realize, hey, maybe I need to relook at am I offering diversified enough options, enough asset classes to help participants manage this volatility? Do we have the right professionally managed solutions that rebalance and diversify? Are the risk levels that are in, let's say, embedded in a target date fund or other types of solutions, are they appropriate? So this is always a good chance to revisit all of those. Maybe I'll touch on the risk level piece for a second. A lot of pundits, sometimes you turn on the TV and they ask about impact on the 401k, and sometimes they say, well, these are long-term investments, so it doesn't matter, stay for the long term. That's true for a lot of folks, a lot of people in accumulation, but those closer into retirement, actually the time horizon is shorter. And especially if they're starting to move money out. Our research shows that those close to in retirement tend to have lower risk tolerance. They are the ones that tend to trade more in down markets and sell low. So you really want to make sure that you're looking at things again, maybe thinking about your target date fund. Is it diversified enough? Is it at the right risk level for your population, for your participants?
Yeah, and it's interesting. We did some research, and we'll provide links with this recording to the research that you all did. We also did some with Pearl recently to look at folks who have one fund available, that they have invested in versus those that have multiple funds. And we saw that as people age, they tend to have more funds. There was a very clear line that as people got older, they tended to move a little more, which, to your point, that might be the group that is a little more nervous, but also has a little more to lose if they're selling in a down market, not as much time to recover, those type of things. So diversification, obviously a first principle in any conversation. But the conversation's now probably a little different, right? Because the market's been moving up for so long, rapidly in a lot of cases over the last several years. When you're talking to your clients, how have those conversations changed? And is anything that you're telling them changing, or kind of like you said, you're always looking at the long term? Is it fairly similar advice that you're giving to them?
Yeah, I would say overall it's similar. I think history doesn't necessarily repeat, but it rhymes. So we've seen volatile periods in the past, and again, as the VIX indicates, there's a lot. Even if anyone goes on and says they know exactly what's going to happen, they don't.
Yeah.
Our portfolio managers certainly would say the same. So you need to take that long-term horizon. I think maybe what's changed is maybe we have more tools now than we used to. That includes different types of investment options. I think that could be available to provide diversification, different types of guidance and advice and personalization tools that can actually help people during these different periods. So I think there maybe the toolkit's a little broader to be able to address the unique risks and needs of defined contribution savers, whether they're in accumulation, near retirement, or in retirement.
Are you getting more questions about this type of things? Some of the other types of investments, maybe fixed income stuff, real estate. Is that coming up more often? I mean, is that kind of like a product of the environment, or do you think that maybe comes later, or what are you seeing when you're talking?
I would say it's a product of certainly the environment now. Folks looking for more diversification. I think it's also a product of this shift of defined contribution plan sponsors as they know they have more aging demographics in their plan. Individuals as they get older, getting more closer to retirement, they have unique needs. A lot of defined contribution plans, I would say this is in the public sector. I see it in the corporate sector as well. They were kind of built for accumulation, right? Whether it's a target date fund, the investment options on the menu. When we've looked at investment menus, which Matt used to point to research before, it's older participants that are tending to use more of the menu options. They're tending to spread out more. But we look at those menu options, it tends to be very equity heavy type options. So you maybe have different style boxes filled out, large, small cap, which are great, but it doesn't really provide the diversification and some of the unique needs that someone closer to or in retirement needs in general, but then particularly for environments like this. So there tends to be, while there may be 7 or 8 equity options, stock funds, maybe there's 2, 3 bond funds. And more diversification and options in the bond, the fixed income sector becomes important. I think more real asset type strategies to deal with inflation risk. Certainly, we saw that spike a few years ago, and those numbers are still more higher than expectations. So inflation sensitive assets, these can be things like real assets, which things are like real estate, commodities, and such. And I think the other tools that we're looking at are not just public markets, but there's also more things in the private market space, bringing more things that traditionally many of your members' defined benefit plans probably leverage. Again, this can be across real estate, bonds, even private equity, potentially other asset classes that that are illiquid that can provide return potential, but also this diversification, which we said is just continues to be increasingly important, and only more so when you have this very volatile, uncertain environment.
Yeah, a couple of great points. We are going to do another Connect conversation just talking about private assets. It's certainly a hot topic, and we do want to dive a little farther into that. We're also going to talk about it at the conference, so stay tuned for all of those.
Okay. Yeah, Matt, if I can make another point, we just did a survey where 73% of plan sponsors said they thought these diversifying asset classes, and then we drilled down even further, like real estate, commodities, they believe could have an important role in these plans. Yet when you actually look at the numbers of plans that are offering this, whether on the menus or on target date funds or all other kind of solutions, you don't see those kind of numbers. So, I think there's a lot of headwinds of why these aren't, but I think we're seeing growing interest in conversations and adoption in many of these types of solutions.
Yeah, that's a great point. And as you mentioned, we also did a paper on stable value. Our last Connect conversation was on stable value. We see the stable value numbers get much higher, as you would expect, as people get closer to retirement. But I think it's a great point that if your diversity is more equity options, that might not be meeting the needs of your older participants. So certainly something to think about for plan sponsors as they're designing the menu. I like that one. And you mentioned personalization, and I think especially in our environment, personalization is incredibly important. You may have people in a hybrid plan, or you may have folks who do or don't have Social Security. You may be in tier 10 of your pension system. Your DC plan can look very different, even within a system. But that makes the picture much more complex for personalization, right? So how do you all think about personalization when you talk about that?
Yeah, I couldn't agree more. I think from certainly just a strategic perspective, all the reasons you just said make sense, and I can dive into that more. People are very different, as you said, even within the same plan, because of when they got hired and what kind of benefits they have. So that's increasingly important. And then I think personalization advice, particularly in volatile times, becomes even more important. Instead of having just generic type of messages around stay the course or check your risk levels, you could be much more targeted and helping people understand, hey, am I on track or not? How much does this change affect my spending power and my ability to withdraw and such? Because people are very different. Again, that's the case across all types of plans. And I think your members are, see this in spades. And there are real differences. We think a little bit more granularly than just, in trying to meet some income goal. Retirement's actually a series of goals. We call them actually needs and wants. So individuals actually have various spending goals that they have, but some are more flexible than others. Some things that are not as flexible. You can think about food, shelter, healthcare. And then for others, categories that are maybe a little bit more flexible, where people can actually cut back on in tough times. And people do, the research shows that they do. They think about vacations, golf club membership, although for some people that may be a need. And people are different. There's generalities, but people actually are very different even amongst themselves. What is, where they feel like they can cut back or not. Yeah. So we can't treat people one size fits all. And the other aspect of that is for needs spending, you would think, well, that's where we want more predictable income. That's where Social Security can play a big role. And I know across your membership, even the coverage on Social Security can be very different. Again, this is where a defined benefit plan plays a really important role. For some, they have their needs spending actually pretty well covered. So in a time like this, even when there's volatility, again, it's not great, but, having to cut back on maybe your more discretionary spending isn't as painful as if you had to cut back on some of your non-discretionary needs type spending. So long-winded way to say, we think the role of personalization is becoming ever more important, especially as folks get close to retirement, And especially during these volatile periods, we think, having this more tailored, customized advice on asset allocation, on withdrawal policies, on Social Security claiming, all the above, actually can make a really important difference and give people hopefully a little bit more confidence in the decisions that they're making.
Yeah, and I suppose because there are so many variables, it becomes a data challenge, right? Getting all of those data points on the same person. I'm guessing there is a program that if you put all those in, or several programs, that if you put all those in, you're going to get a pretty good answer, but it's really getting that data to that spot. That's the challenge.
That's for sure. There's no doubt about it. The advice is only as good as the data you have, but there's more, usually there's more data than just age, and you can incrementally help it's not just a binary. I think there's a lot of things you can do along the way to give more personalization, but also try to get more information either from the employer or from the employee to try to even use technology and other sources to give even more personalized advice.
Yeah, and I think some of our members that I've seen do it really well get feeds from the DB side too, that will have salary and tenure and a lot of the variables that you would need, whether or not they're in Social Security, what tier they're in, that would feed the DC side to answer some of those questions. And maybe we'll have somebody on to kind of talk through that process. But I do think personalization, as you mentioned, is going to be really important for our folks. It's a very diverse group as far as what systems they're in and what the outcomes can look like. So, all right, we're kind of running late on time. I do want to close on one thing. We're talking volatility. We're talking kind of the macro environment a little bit. We've seen a lot of this in the past, right? The dot-com bust, the great financial crisis, things like COVID, inflation, which you mentioned. A lot of those kind of seem like acute events, right? Like a thing that happened and you go, okay, the plan is to right the ship. We're going to get back on course. What are the things that we need to do? You see the government kind of stepping in a lot of those cases. This does seem a little different, right? It's a little broader. It's a little harder to know like what direction this is all going to turn out. So, are you looking at this situation and you go, the fundamentals are the fundamentals, like anything else, and that's how you approach the future? Or is your team kind of taking a step back and rethinking some of this stuff and going, okay, if we don't know exactly how this is going to turn out, we have to have some different courses that we're thinking about as we work with our clients?
Yeah, when I talk to the portfolio managers across my organization, whether it's those that run the target date funds or individual strategies, I think they are much more humble about trying to predict what can happen. I think, many are looking, how do we manage risk appropriately, make sure we focus on the fundamentals. Again, to predict things based on policy and politics become even more challenging than even normal market predictions have. So I still think it comes back to where we started in the basics of, to have a long-term perspective, be diversified, know your risk, but use this as an opportunity to really to remind yourself that these are really important, because they don't tend to be as thought about or important when it's just an up market.
Yeah.
Right. The committees, just by human nature, everything's going well. So you don't kind of think about the what ifs and what could happen. So this is another good reminder that these are types of things that both plan sponsors, their committees, and then also hopefully we can tell the participants too, things that they need to make sure they're thinking about and focused on as well.
Absolutely. Well, Josh Cohen, I could do this all day, but it's been great to talk to you. We do have to wrap up. Thanks for coming on.
Thanks, Matt, for having me. I really enjoyed it.